Go ahead and record it. Kevin, you want to kick us off tonight? Oh, you're on mute, Kev.
All right, good to go. So I'll just do a couple quick announcements. We'll do some introductions, jump into the conversation that Frank is going to stimulate, and then some Q&A after. So some quick announcements. We're very consistent with our meetup over here. So we're going to have another one first week of every single month, next Tuesday, October 6th. So we'd love to see you then. Another big announcement is one of our counterparts, one of the founders of MFM, Kyle Mitchell, is holding our free virtual asset management workshop, or summit is what he calls it. So that's going on between the 21st to the 4th. I'll send and I'll put that information in the chat. So if you guys want to register for that, it'd be really educational information. A lot of great speakers, Brad Sumrock, Joe Fairless, Neil Bawa, a lot of the people who are closely tied to the multifamily commercial real estate space will be speaking there. In terms of today's content, keep in mind that it is purely for educational purposes and educational. So please make sure that before you take any moves or steps on this information, consult with a legal professional as well as a financial professional. And then really quickly, our mission statement, the reason why we've grown so much over the past 2.5 years is because we are a grassroots community really centered around the education, connection, and empowerment of people to grow their wealth and through real estate. And that's really resonated with a lot of individuals. So a lot of what we do is free content to be able to connect people across the nation and even globally to invest in commercial, specifically multifamily. And in terms of, as we're going through the meeting today, just a reminder, if you have any specific questions, feel free to type them into the chat. Brian and I will source them and make sure that they get answered. If relevant to what's going on in the flow of the conversation, we'll ping Mandy and she can ask that question as well. And then afterwards, what everybody loves is the breakout session. We're going to do 2 15-minute sessions where you can kind of meet your colleagues and counterparts, see what they're up to, get their take on what's going on in the world, and kind of where they're going to pivot or what they're investing in currently. So any other items, Mandy, Brian, that you want to announce before some quick little intros for all of us?
I think maybe we should spoiler who our guest is next month too, don't you?
Let's go for it.
Sterling White is going to be joining us. He puts out a ton of content on Bigger Pockets. He's a multifamily investor, focuses a lot in the Midwest. So it'll be very interesting to get his status of what he's doing with his portfolio right now. So we're pumped about that. Good follow-up to Frank. Excellent.
Frank, you want to give us a little bit of a background?
Sure. I'm formerly of Wall Street. I used to work at the Federal Reserve Bank of New York. That's where I was located out of. I spent some time down in DC. I've been investing in commercial real estate. I started about 24 years ago while I was still on Wall Street. Shortly thereafter my career at the Fed ended, I went over to JP Morgan Chase. And then I left. I was only there for a little while, and I left there about 21 years ago, where I've been on my own, where I've been a full-time real estate investor. I ventured into some other things, owned a laundromat, owned a construction business, to somewhat vertically integrate. And it's been quite a ride. Absolutely love it. I couldn't imagine doing anything else. So my background is in economics. I went to law school, and as much as I am intrigued by law, I found myself thinking that I don't really want to be a lawyer. I could satisfy my quest for, legal interest by pulling down some decisions from the United States Supreme Court and reading through theirs and seeing how they got their analysis to their conclusions. So
yeah, scratch that itch, right? So when I think Wall Street, at least in my economic brain, it's not a hand-in-hand thing usually for someone who is on Wall Street to end up as a real estate investor. So I think you're in this pretty unique situation with your Wall Street pedigree, with your having worked with the Federal Reserve, I'm really interested to dive into how that life informed your investing career, and maybe how you got into what type of assets you did. Can you maybe speak to that a little bit?
Absolutely. So when I was at the Federal Reserve, the Federal Reserve is basically, well, I mean, besides, of course, being the central bank, each local district has various divisions. And there's a division such as, operations, which is like cash management. There's obviously the overmarket committee, which does the day-to-day trading, intraday trading with the registered broker-dealers. And then you have this broad group called bank supervision. And I was within that group in a small subset. Most of them are commercial bank examiners, and then there's a small subgroup called specialized examinations and trusts. And so I was actually in the trust world, but it was very unique in that most of what we did, we looked into and dealt with some special situations, and I could only pass it along as that. When banks dealt with where they were in the position of a fiduciary on behalf of wealthy clients.
Mm-hmm.
There were some other things as well outside of that, like for example, like operations at DTC, which is a depository trust company, which is where all the shares of all the stock that gets traded is held.
Mm-hmm.
So there's counterparty analysis that goes on when you're trading with somebody in case of what happens if they default on the counter side. And then there's systemic risk within the banking industry. So it really, it was quite exciting work, and I absolutely loved it. It was, and I feel very fortunate to have, been within that group because there were certainly a lot of wonderful people that I worked with. But on the fiduciary side, within the banking side, one of my specialties was asset management, because I was a former investment advisor in a very small boutique firm prior to my entry into the Federal Reserve. And it's within there that I sort of found that high net worth individuals are not commonly known, nor are they of the people that you may think that they are. Like, for example, they're not the Madonnas and the Michael Jordans of the world, although they're certainly within that group. A lot of them are just simply small business owners that absolutely loved what they did. And part of being a business owner in their asset world of what they had insofar as their wealth, commercial real estate was a cornerstone of that wealth. So that's where I saw this pattern, which ironically enough, about 2 or 3 years after I discovered it, Thomas Stanley, or Stanley Thomas, I always get that mixed up, came out with his book that he co-wrote with someone else called The Millionaire Next Door.
Mm-hmm.
And I was absolutely fascinated with that book. I think it's a must read for anybody who wants to really get a grasp on what millionaires are really like. And it's exactly what I was seeing. And shortly after reading that book, someone passed along to me a book that's known a little bit more, although not too much. It's, a lot of people just don't know about it. It's called Rich Dad, Poor Dad.
That one? Just that? Never heard of it.
Maybe some of you heard of that one.
Yeah, that one?
That book, when I got done reading that book, I immediately sprung into action, and I bought an 8-family garden apartment complex a few months after that, and I've never looked back.
Awesome. So kind of what I hear you saying is you saw that these high net worth individuals really had some sort of commercial real estate, and then you did kind of the appropriate learning in the interim, and that put you into action, which actually kind of speaks to something that I read that put me into action, that if you look at the 1%, some ridiculous figure of them, like north of 80%, became wealthy because of a real estate investment. So I like how you backed into that idea. So,
Yeah,
sorry?
and I would just clarify that I really didn't do that much education on the commercial real estate side, because being on Wall Street, you walk around, you hear a bunch of things. So there's a guy by the name of George Soros, which maybe some of you have heard of, maybe you haven't. I don't really like to mention his name because he could be a little bit of a hot potato politically. And some people will, oh God, whatever. But he ran the quantum fund, and he was very successful at what he did without any question. And I was listening to him speak once, and he said that when he comes to analyzing investments, if he likes an investment, he'll jump in with both feet. If it doesn't work out, you could always pull a foot out later. And that was just the deer in the headlight moment for me.
Yeah.
And I saw this 8-family, ran the numbers, obviously a numbers guy, made sense, jumped in with both feet, figured it
ready, fire,
out
aim.
along the way.
Make
Yep,
it happen.
absolutely. Yep,
I love
absolutely.
it. So I happen to kind of know where you're at in we've spoken about it at length before. So I know that you are not an active buyer right now, but if you were, given the state of everything you see, what sort of assets would you be looking to purchase if you were a buyer?
If I was the buyer, I would definitely stay in the apartment world. I'm an apartment guy, residential, I sometimes claim it as commercial real estate, and it is commercial real estate. But commercial real estate obviously has a bunch of different facets to it. There could be industrial, there could be office, there could be medical, there could be special use, et cetera, et cetera, et cetera. I simply focus on multifamily. That's my world. That's what I know. That's what I stay in.
And we
and I
picked
love
the
it.
right guy to be our speaker here. Thank you.
Yep.
Yeah, I think you're in good company, because that's why, people need a place to live. And if you choose a place with, good growth, the tide will carry you, right?
Exactly.
I'm interested to know, in terms of economically speaking, our current situation, with what, we haven't ever seen QE, quantitative easing, or, let alone QE3 ever before. In terms of, the short-term and the long-term effects that you could possibly see, kind of keeping an eye on multifamily investing, what do you think current state has done to our investment vehicle of choice?
There's lots of different facets to that question. First and foremost, I think it's important to be cognizant of the fact that there's a strong shift going on in the market right now. And that is happening as a result of political unrest, or maybe not political unrest, but certainly political pressures. So I think, generally speaking, you're going to see a migration. You're seeing it actually now. The numbers, correlate to this. You're seeing a mass migration out of urban cities. So in the multifamily space, you've had this gentrification play going on for the past 10 years, 20 years, maybe even longer. And that is all, I think, stopped, in my opinion. And I don't think that we're going to go back there for two reasons. One, what's going on in the inner cities, which is horrific. And then two, it's a function of being safe, because people have been scared to death, literally, with this COVID-19. A lot of people are not paranoid, but certainly concerned about their well-being. Maybe some aren't, whatever. But nevertheless, I think we're going to see a lessening of intensity from a planning standpoint. I'm a former chair of a planning board, so intensity means, more people packed on top of one another. Less intensity means, less people. So I think there's going to be a migration flow of people seeking areas where they have some grass, they have some space in between them. So in the multifamily space, I think high-rise buildings may not fare as well, relatively speaking, to say a garden apartment complex, where you may have your individual access and egress, to and from your own unit without getting into a common area, such as in a high-rise in an elevator. You can't escape it, right? So, and I think there's going to be a flow towards some markets, like in Idaho, for example, places where previously they may not have been thought of as a place to invest in multifamily because of lack of population. But I think you're going to see that migratory flow.
Right.
That's on one side. On the second side, with easing, clearly we've seen interest rate drop, and as interest rates fall, you see a rise in multifamily pricing and even real estate pricing. Prices of housing has gone up. Generally speaking, there's that inverse relationship. But as the money continues to be pushed into the economy, you can't help but think from a broader perspective, what happens, what are the consequences of spending? And some numbers that I've heard are that we're now printing over 50 cents. We're printing and spending over 50 cents of every dollar that over what we take in.
Wow.
So how long does that last? How long does
Right.
that go on? And what does that look like? So, and this is where you get into the heady economist think type
Reserve currency situation.
areas.
Yeah.
Exactly. And this is a little bit removed from more specifically multifamily. This is more broad. And we can get into that, but there's some thoughts. I think there's a general school of thought that's concerned about hyperinflation if the dollar was to lose its reserve currency, and you.
Right. Uh-oh. Is it just Frank?
Is it just me?
There he is. Welcome back.
Okay. Sorry.
Yeah. No, hyperinflation, reserve currency. And I'll tell you, like I do kind of in the last bit of our talk here, I want to get into what you think future state will be. So I would love to dig into that. But in terms of, current situation, you did mention political unrest. And I think that's, clear. And I think that, maybe deserves like your thoughts around not anyone's political leanings or anything like that, but, the economy will respond differently given which candidate wins, right? So if you could maybe walk us through your thoughts on what might happen to multifamily and lending should one candidate win and then should the other candidate win, meaning just political party, not the.
Right. I think that there's significant risk in the multifamily space as a result of where we're going as a country. So notwithstanding whether an R or a D gets elected, I think that the country, generally speaking, is moving towards and wanting, or the loud calling that we're hearing is a push towards socialism. Now, a lot of people think that we live in a capitalist society. We don't. Sorry, have news for you. We're not a capitalist society. As much as we like to brag that we are, we're not. There's a lot of regulation, there's a lot of oversight, there's a lot of government. And I only see more of that happening because there's a cry and there's an expectation that people want assistance and people want help. Again, generally speaking, maybe not you individually, but generally speaking, of course.
Well, given that then is Section 8 the play? Is that what is maybe that
Well, Section 8 could be the play, but then of course it could come with some regulatory risk. Like, for example, we've seen that there's a stay on evictions should the property receive any sort of government assistance.
Mm-hmm.
So if you have a Section 8 tenant, under normal circumstances or what happened in the past, you can evict, even here in New Jersey, which is where I'm located, and you could evict if they don't pay their portion of the rent, and then they're supposed to be kicked off the program if that happens. And then there's an appeal for that, and it doesn't normally happen, but whatever. But now, depending upon what portion is coming from the government and what portion they're receiving or they're supposed to pay, what does that look like? And your total number of units, what does that do to your bottom line? If in the example, X percentage of your Section 8 tenants do not pay. And moreover, if they're not paying and you can't evict them because there's a federal rule, because the people in power agree with some of the people who are clamoring about that, rent is a basic right.
Right.
What does that look like? I don't know. It's very difficult.
I don't think my crystal ball is broken. Yeah, but
Right.
I'll tell you, it is an interesting thing to hear. I have a friend who's actually joined us from Silicon Valley who, California is doing some things to forgive rent. What happens to landlords there? I guess, we'll just kind of have to stay tuned. I do want to dig into this idea behind reserve currency. Because, we're, as Americans, getting away with murder. We can print as much money as we want, inflate away, do whatever we need. And in my opinion, the reason I like hard assets and locking in good long-term debt is because go ahead, inflate it away. It'll be great for my business plan. But what happens if we are seen as irresponsible and lose that spot as reserve currency? So in your opinion, what happens to multifamily as an asset class and lending around that if we can't bank on being able to print money?
If we lose status of the reserve currency, and we've certainly been abusive with having a fiat currency. As you know, we're not backed by gold. We haven't been for a long time. People blame Nixon, but we've wandered off the gold standard a long time before then. Nixon just did the official act of closing the window. And in that time, if we've continued to print money and we've continued to run, not to have anyone feel any sort of pain during any economic downturn. Should it lose the reserve currency, and there's a whole world on debate on how that may or may not happen, and what happens in that case, where would they go? People talk about a gold standard, whatever. In the case, if that happens and we have inflation and a rampant rise of cost of goods and products and services, people talk about going to the gold standard. That may or may not happen. I don't know. I don't think we're ready yet to go into McDonald's and pay for a Happy Meal with some gold nuggets, right? I think we would go to a bartering situation, which is typically what happens. It happened in Russia back in 1991 after the Berlin Wall came down and money was useless over there. People were paying for services with Marlboro cigarettes, for example, and Levi jeans. Ray-Ban sunglasses were commodities over there that you could trade with. So that's what we see in that sort of collapse of an economy. Generally speaking, hard assets do thrive in that sort of thing because it's land.
Right.
But then you have the counter effect of, well, that's great if you have the land, it's going up in value, but how valuable is it if your apartment building is empty, or
Right.
your apartment building has a bunch of people in it that are not paying their rent?
Right. it becomes like a yield play, but can whoever lives that's paying that rent, I mean, how far do Ray-Ban sunglasses to feed your kids go to feed your kids? You know,
Right.
so yeah, that's an interesting, I mean, that seems so like 1984 Ian Rand pie in the sky, but how, like, if you're a betting guy, you know, 1 to 10, what's the likelihood of a collapse of an economy like that happening and us losing reserve currency? You know, where do you put your chips?
Under normal circumstances and for a very long time, I would probably say that it would have been at like at a 0 to 2 range, depending upon what was going on. And for the most part, I don't really follow politics that much anymore, Mandy, as you know. But nevertheless, I'm still. But you know, you train to look at long-term, or I'm trained. An economist is basically trained to, in order to somewhat with some level of confidence of predicting where the future will go, you have to establish long-term trends.
Mm-hmm.
And what's a long-term trend? A long-term trend is that we are, you know, lunging forward towards a socialist country. We don't produce that much here in this country anymore. I was shocked to find that IV fluid, when the COVID-19 broke out, we only had one factory making it, and it was in Puerto Rico, and it was down. The rest of it was coming from China.
Mm-hmm.
So I don't know what sort of migratory switch will go on with how things are being produced.
Meaning
But
you think more things will be American made. Did I gather your thoughts correctly?
I think there's a very strong case that they should be.
Mm-hmm.
And if we become more independent, more self-reliant, which hopefully is something that we will see, if people will recognize coming out of this. But in doing so, to get back to your question, where the reserve currency, what's that look like? I do think that there will be some sort of pullback, because I think at the end of the day, all politics is local. And I
Mm-hmm.
think other countries are going to start looking to fend for themselves. I think America has gotten away with a lot over the years, and being fiscally irresponsible. Are there other countries that are more fiscally irresponsible than we are? Yes.
Greece.
Did they? Yeah, Greece is one, Japan is another. You know, but by levels of debt versus GDP, right?
Mm-hmm.
However, how you want to. But you know, that's Greece and that's Japan. Japan's an island. You know, not to minimize Japan, but it relative to the United States,
Right.
and how other countries look at us to be a superpower, to act as, you know, they want America in a lot of different things.
Mm-hmm.
I was formerly married to someone who came from Europe, and there's this thing about, you know, America being the world's police, but we often get pulled in because it's not like that we look to be the world's policemen. We get pulled into that role. But back to your point, or if I was to, my number being a 0 to 2, depending upon what had happened in the past, I am probably now at a 4 to a 5, because I do think that there's going to be a pullback of other countries, whether it's the EU as a bloc, or if the
Mm-hmm.
EU comes apart, which has long been my thought.
Interesting.
I never saw the United States of Europe.
That's great.
But this goes back to us debating about it back in the day in
Yeah.
the 90s before it happened.
Right. So we went through a little bit of, you know, current state stuff. Well, take out that crystal ball of yours, if you don't mind.
Sure.
Tell us, you know, in terms of, you know, fiscal policy that you potentially see. We kind of went into that with the, you know, people wanting things, the, you know, potential move towards socialism. What do you think that will end up doing to, you know, in the, not the long term, but maybe let's say shorter to middle term? What does that do to asset pricing and cap rates and lending that's available to be ascertained for these multifamily assets?
I think it's going to be dependent upon the state. But where you're operating, I think the biggest risk that most people don't account for when they're looking at multifamily is the regulatory risk.
Mm.
And I think you're going to see a greater push by government on property owners, the evil landlords, a term which I very rarely use because I actually disdain the term. It's such a medieval term. I was once in court as a quick side story, and I quipped to the judge because he asked me if I was a landlord. I said, no, I'm a property owner. I don't tax the residents who live on my property on their harvest of potatoes. And he chuckled, of course, and it was a light moment in the courthouse. But that aside, I think there's going to be a stronger regulatory risk. And we see this all the time. Here in New Jersey, for example, I wrote an article for the Bigger Pockets about staying informed locally because it was a city that wanted to impose to keep their residents safe. Normally, that would be a function of police powers, but they wanted to push it onto property owners, and the legislation that was introduced was to have security guards on site for any property that had more than X amount of residents or X amount of units.
Hmm.
Now, that may and it may not be something, but if you think about armed personnel or trained security personnel, because you need to have trained, otherwise you're opening yourself up to litigation risk. But if you want to have armed and trained, I'm sorry, I think there was, it had to be armed. So you start pulling off the numbers of what that costs and what that looks like. Now you're imposing like a $50,000, $50,000 to $75,000 tax on unfunded tax on property owners in that city.
That's interesting. So, I mean, basically what I'm hearing you say is from the beginning, we were saying high-rise apartments are scary, which I totally agree with. I'm seeing, I can't sell a condo in Chicago to save my life, but these, suburban houses are flying off the shelves here.
Yep.
So we're seeing that happen real time. So, maybe secondary, tertiary markets are ideal. And, in this I'm interested to know from regulatory risk, what would you do to hedge that bet? Or can you?
It's not something that you can hedge, but in a way you can if you were to go to a less dense area in a more in a friendlier state, so to speak, where they would like to see some growth, some economic growth. And there are municipalities out there that do want to have that. And that's all around the world.
Mm-hmm.
I mean, even in Italy, it's famous, it's well known that they sell old homes. Some governments are willing to sell a home for €1.
It happens in Michigan too.
It does it? Yeah. So I wouldn't be interested in moving to Michigan. I'm more set on Italy, but nevertheless, some municipalities welcome that development and growth and want to expand their population. And I think in those sorts of markets, you might be able to fare better as compared to a larger market where there's more people and greater density. But again, the thing there is that there's a flight. I mean, this is history repeating itself. So I don't know the average age of the population here on this call, but I was very young. But nevertheless, I do remember when, again, I'm here in New Jersey. We had race riots back in the 60s. I was a very young boy, and I happened to be in the back of my father's car, bouncing around from the floorboards to the seat. No car seats back then, no seat belts. And I was with my sister, and we were driving not to Newark, but we were driving in that direction, and we were stopped by the National Guard. And I remember that because I used to play with G.I. Joes. What a wild thought, a young boy playing with G.I. Joes back in the day, right? But th- but they were nevertheless there was a National Guard member there in full, green fatigues, or green utilities on, and we couldn't get through to get through the car dealer.
Bananas.
So we had to turn around and go back, and then that started an economic phenomenon of white flight, suburban sprawl, and all that other jazz. And there's white papers if you're interested in putting yourself to sleep. There's a whole bunch of white papers out there written by economists that delve into that. Very interesting, I find, but nevertheless, you're seeing that all over again.
Awesome.
Because people want to be safe, and they want to be safe from someone sneezing in the same building, and they also want to be safe from
riots
of riots, and not seeing people use drugs and so forth and what have you in the streets. And that's, by the way, I'm in the shadows of New York City. New York City is literally right across the bay from me, and that's what you're seeing. And I don't want to sound like a worry, I don't want to sound pessimistic or whatever, but I was just having this conversation the other last week with somebody who knows some building owners in New York City, and they were millionaires, and they're going to be filing for bankruptcy.
I'm sure. Well, I mean, I tell you what, I mean, I've had troubles with these primary markets for some time. So you're talking to a girl who invested in a building in Kenosha, Wisconsin, thinking it was a really awesome tertiary market. So big high five to me on that one. But what I'm kind of hearing you as a little wrap up here is you want, my notes for how I'm going to inform my investing based off our conversation are: I want landlord friendly, I want secondary or tertiary markets, and I want smaller properties. So I'm super grateful for this conversation, Frank. My co-host, do you have any questions maybe to rapid fire here before we toss over to our networking portion?
Yeah, we had a couple of questions come in that I can address real quick. And guys, anybody else has questions, feel free to message Kevin or I, or just throw them in the chat box. But Frank, you talked about interest rates earlier briefly. Given the state of the economy and where things are at, would you expect rates to stay where they are over the next couple of years? Like, what do you think the next step for the Fed to be as far as when they might actually come in and raise rates?
In my opinion, they will keep rates as low as possible. If they start to raise the rates, then the federal government's going to have to pay a lot more in interest, and they can't do that. So the interest rates have been declining for years. When I first got into the business, commercial interest rates were typically 9-10%.
Right now in today's market, are you more of a fan of stabilized or value add opportunities?
Stabilized. I want cash flow from day one. Cash on cash return is my number one analytical tool. I don't care about anything else. Anything else could be sugared and powdered to make it look attractive.
Yeah, we've seen the shift in people wanting more stabilized properties right now because it's hard to know what you can rent the unit for after you rehab it in 12 to 18 months. It's just too hard to predict those rents going forward.
Yep.
If you were starting out today and looking to acquire your first property, what advice would you give to somebody looking to start out today?
First and foremost, broadly, I think that generally speaking, Americans are not in good financial condition. So I would say make sure your financial house is in order. Make your balance sheet as strong as possible. Put yourself in the best possible position. Having said that, I would look into markets that are, as I mentioned, that are not only friendly, small, good mix of people, stable, where the tenant's income is coming from. Like, for example, I happen to like Florida. I was looking into Florida for a while. I was looking into a market, though, that I had some reservations about, and I never bought. And fortunately, I didn't, because the area that I was looking into, as much as I liked it for a rental market, was predominantly built on tourism and socializing, bars, clubs, etc. So I wouldn't be interested in something like that.
Another one that came in was, with all the money being printed currently, what is your opinion on future asset inflation?
So when you have a lot of printing of money, you run the risk of devaluing a currency and you're getting into hyperinflation. And there's a ton of books out there if you're interested in, continuing on learning that. And hyperinflation, though, again, hard assets do tend to hold their value, but or rise in value. Real estate rose dramatically during the 70s, where we had some really strong pushes, cost push inflation. Because we had Nixon with wage and price controls, and then we followed up by Carter by expansionary fiscal policy with an expansionary monetary policy at the Fed. With the Phillips curve and the misery index and stagflation and all that jazz. Just bear in mind though that although the asset could be rising in value, it's holding on to it. It's having the ability to hold on to it, and the ability to hold on to it is going to be determined based upon how well you purchase it, how stable it is, and how low your leverage is. So Mandy already knows this, but my portfolio, I only have leverage on it at about 40%, 45%. And I had one property with a partner, and it became somewhat destabilized as a result of us going back and forth and not anything being done to the property. But I was able to get to, I had a 43% vacancy at one point with a bunch of units empty, and it was still positively cash flowing. So that's the type of property that I would be very comfortable on going forward, because I know I can weather whatever storm is going to be thrown at me.
Yeah. We've all heard about a lot of money sitting on the sidelines right now. What do you think the impact of that is on the markets?
The amount of money sitting on the sideline is just reflects what we all know. There's uncertainty. There's uncertainty with the election. There's uncertainty where this country is going. There's uncertainty with COVID-19. There's uncertainty to what our future looks like. And there's a lot of anxiety. There's a lot of hand-wringing going on at the moment. So it doesn't surprise me that there's a bunch of money sitting on the sidelines. I think money will come off the sidelines if there's a good case for an asset to be purchased, multifamily assets to be purchased, that shows good cash-on-cash return from day one, and is well poised, so that even if there is some sort of uncertainty going forward, and there might be some waves, with the political front and the regulatory risk and et cetera, as we discussed previously, I think people will they'll be smart to come off the sidelines and purchase. I think some multifamily assets in some markets, some people think that there's a fire sale going on, and people have been looking for a buying opportunity. I don't think we're there yet. I think by and large, a majority of the assets that are being marketed are still very close to full value, without that much of a great deal.
And I think the last question we have is, what are your thoughts on vacation rental markets? Do you see those rebounding, and is that a good investment right now?
I would shy away from it personally. I don't think, because of the comment that I mentioned earlier, where I've seen some numbers where over 50% of the population cannot put their hands on $1,000 in an emergency situation. And I think I would hold off until the stimulus money stops, because I think that's going to be a true unveiling of what state we're in as a country, without the $600 per week or what people are getting. I don't know, because don't get any of that stuff. So, and I haven't applied for it or whatever the case may be. So what people are getting insofar as financial stimulus or insofar as forbearance is concerned with help, I think all that needs to stop. And I think all that needs to unravel. And then you're going to see who's standing and who isn't. And depending upon what that looks like, that will determine whether or not people have disposable income to go to some vacation rental and join in an Airbnb. Just my thoughts.
Okay. No, it's great feedback. Thank you very much. I think we're good with the Q&A. Kevin, was there anything else that I missed?
No, you pretty much covered a lot of great questions. So once again, the big thing to keep in mind here is to really formulate your investment thesis going forward. There's a lot of uncertainty in the market, and as Frank mentioned, there's a lot of money on the sidelines because of that uncertainty. One thing that really resonated is invest in something that's actually producing. So cash on cash. Make sure that if you do buy anything right now, that it's generating income and that it can weather a storm. You're not over leveraged. So any other items, Mandy, Brian, before we break out into the networking event or networking portion?
No, Frank, thank you so much for joining us. This was huge.
Thank you for having me. I totally enjoyed it. Hopefully you got some value out of this. I didn't scare you because that wasn't my intention, but a good smart buyer going forward, I think will do well in the long term.
100%.
Awesome.
So.
All right, thanks, Frank. So we're going to go into the breakout rooms. I'll get you guys in there in just a minute. Probably do 12 to 15-minute sessions. So let's.
Yep, and just to give a little bit of context, name, where you live, what you're working on, and just try and get to know your counterparts to see what they're seeing, because right now there's a lot of change that's going to go on in this current cycle.
All right, so you guys should be getting moved over in just a second here.